Hello everyone, and welcome to Virginia International University's MBA 605 online auditing course. In this session, we're going to talk about the audit of the inventory and warehousing cycle. As we have with other cycle discussions, we're going to first start off with describing the business function and the related documents and records that are incorporated into the inventory and warehousing cycle. We'll explain the 5 parts of the audit of the inventory and warehousing cycle. We'll design and perform audit tests of cost accounting. We'll apply analytical procedures, which we've done in numerous other business functional areas, to the inventory and warehousing cycle. We'll also design and perform physical observation audit tests for inventory, which is something a little unique to the inventory and warehousing function. We'll design and perform audit tests of pricing and compilation for inventory, and we'll integrate the various parts of the audit of the inventory and warehousing cycle. The inventory and warehousing cycle can be thought of as comprising 2 separate but closely related systems, one involving the physical flow of goods and the other the related cost. 6 functions make up the inventory and warehousing cycle. And here we see the various accounts that are related to these functions, such as raw materials, direct labor, manufacturing overhead, which are really related to the inputs to the work in process or manufacturing process, which then moves through the work in process, through the manufacturing, to culminate in finished goods, which are then, as they are sold, transferred to cost of goods sold. And so first we see that raw materials are acquired for production. The receipt of ordered materials involves the inspection of material received for quantity and quality. Once received, materials are normally stored in a stock room. So they stay in raw material storage until they're pulled to be used for production. Companies determine the finished goods items and quantities they will produce based on specific orders from customer, sales force, forecast, predetermined finished goods inventory levels, and economical production runs. When finished goods are completed, they are placed in the stock room to await shipment. Shipping completed goods is a part of the sales and collection cycle that we'll talk about later. So the tests performed in the acquisition and payment cycle and the payroll and personnel cycle should satisfy the auditor that controls affecting the acquisitions of raw material and manufacturing costs are operating effectively, and that acquisitions of raw materials and manufacturing costs are operating effectively, and that acquisition transactions are correctly stated. When labor is a significant part of manufactured inventory, auditors should verify the proper accounting for these costs in the payroll and personnel cycle. So again, we can see how these business functions or these business cycles that we've been talking about are all interrelated. Internal transfers of inventory include the 4th and 5th functions. Clients account for these activities in the cost accounting records. So recording shipments and related costs is the last function shown. Since it is part of the sales and collection cycle, auditors obtain an understanding and test controls over recording shipments as part of auditing that cycle. Auditors must observe the client taking a physical inventory count to determine whether the recorded inventory actually exists at the balance sheet date and is correctly counted by the client. And so that's why it's important when we have clients who are manufacturers that have high levels of inventory who are doing counts that we're engaged early enough on that we can observe and attest to the propriety around the physical inventory counts. Auditors must perform inventory compilation tests to verify whether the physical counts were correctly summarized. Cost accounting controls are those related to processes affecting physical inventory and the tracking of related costs from the time raw materials are requisitioned to the completion of the manufactured product and its transfer to storage. And so here, again, we've seen this before in prior cycle reviews where the methodology for designing controls and substantive tests starts with understanding the internal controls around the cost accounting system, assessing the planned control risks, and then determining the extent of testing these controls. And once we determine that extent, we move into the designing of the test of controls and then substantive test of transactions for the cost accounting system to meet transaction-related audit objectives. And that last phase involves determining audit procedures, the sample size, items to select, for testing and then the timing of those testings. The concepts in auditing inventory cost accounting are not different from those discussed for other transaction cycles. The auditor is concerned with the four aspects of cost accounting which we see here: physical controls over inventory, documents and records, which we talked about for transferring inventory, perpetual inventory master files, which may relate to the inventory counts, and then unit cost records. The auditors test the physical controls over raw materials, work in process, and finished goods are limited to observation and inquiry. The auditor's primary concerns in verifying the transfer of inventory from one location to another are that recorded transfers exist, all actual transfers are recorded, and the quantity description and date of all recorded transfers are accurate. The reliability of perpetual master files affecting the timing and extent of the auditor's physical examination of inventory. When perpetual are accurate, auditors can test the physical inventory before the balance sheet date. Accurate cost data for raw materials, direct labor, and manufacturing and overhead is essential for fairly stated raw materials, work in progress, and finished goods inventory. And so again, and as we've seen in multiple cases before with respect to these business functions or cycle audits, we can perform, or we must perform, analytical procedures. And in this case, some of those would include comparing the gross margin percentage with that of previous years to determine how are we managing costs, and are costs increasing? Is there a reason for that? Are costs decreasing? Is there a reason for that? We might also compare inventory turnover, and that's good. Cost of goods sold divided by average inventory with that of previous years, so that we can test to see whether there's obsolete inventory, overstatement, or understatement of inventory. We might also compare unit cost of inventory with those of previous years, or compare extended inventory value with that of previous years. And then finally, another analytical procedure we could use would be to compare current year manufacturing costs with those of previous years. And so again, all of these we're looking for trends, we're looking for relationships between financial and non-financial information, and where the answers don't make sense to us, then we need to have management provide us with an adequate explanation of what these trends are and what they mean and how they got there. So auditors often first familiarize themselves with the client's inventory by conducting a tour of the client's inventory facilities. Auditors have been required to perform physical observation tests of inventory since a major fraud involving the recording of non-existing inventory was uncovered in 1938 at the McKesson and Robbins Company. The fraud was not discovered because the auditor did not physically observe the inventory, which at the time was not required. And so now auditors are required to observe the inventory. And if the auditor is not hired or engaged in enough time to be at the facility to observe the inventory, certain other steps are required to ensure that the integrity of the count is maintained. Regardless of the inventory record-keeping method, the client must make a periodic physical count of inventory, but not necessarily every year. Auditors need to understand the client's physical inventory count controls before the count of inventory begins. Obviously, if the client's physical count controls are inadequate, the auditor must spend more time making sure that the physical count is accurate. The auditor decides whether the physical count can be taken before year-end primarily on the basis of the accuracy of the perpetual inventory master files, and that assumes the client uses the perpetual inventory method. When the perpetual records are accurate and related controls operate effectively, it may be unnecessary for the client to count all of the inventory at year-end. The number of inventory items auditors should count is difficult to specify because auditors concentrate on observing the client's procedures rather than on selecting items for testing. The key determinants of the amount of time needed to test inventory are the adequacy of internal controls over the account, accuracy of the perpetual records, total dollar amount and type of inventory, number of different significant inventory locations, and other inherent risks. When auditors observe the client counting inventory, they should be careful to observe the counting of the most significant items and a representative sample of typical inventory items. Inquire about items that are likely to be obsolete, and discuss with management the reasons for excluding any material items. And so here we see that the most important part of the observation of inventory is determining whether the physical count is being taken in accordance with the client's instructions. And so the auditor has a responsibility to understand what how the client conducts their fiscal year-end count, and then they are responsible for ensuring that the actual count is done consistent with those instructions or policies. And in many cases, the auditor may have to travel around to multiple different locations in order to observe these counts. And so when we're auditing balance sheet accounts, we're looking for assertions related to the existence of inventory, that it is recorded as they exist, that inventory is counted and tagged, its completeness, that it's counted accurately or its accuracy, and then that it's classified correctly, and that's the classification. We also look for cutoff, realizable value, and rights assertions to ensure that transactions are recorded in the proper period, that obsolete and unusable items are excluded or noted, and that the client has rights to inventory counted. That is, that they're not counting something that someone else owns or that title hasn't passed to the client for. Auditors must verify that the physical counts or perpetual record quantities are correctly priced and compiled. Inventory price tests include all of the tests of the client's unit prices to determine whether they are correct. Pricing purchase inventory includes the categories of raw materials, purchase parts, and supplies. The auditor must determine whether the client uses LIFO, FIFO, weighted average, or some other method. In auditing the pricing of manufactured inventory, such as work in process and finished goods, the auditor must consider the cost of raw materials, direct labor, and manufacturing overhead. And then in pricing inventories, auditors must consider whether replacement cost or net realizable value is lower than historical cost. So when auditors verify inventory acquisitions as part of the test of the acquisition and payment cycle, they are also obtaining evidence about the accuracy of raw materials acquired and all manufacturing overhead costs incurred except labor. And so again, this is a good example, and it points to the interrelatedness of the business functions and how when auditing some business functions, we're also satisfying audit requirements related to other business functions or cycles. When auditors verify labor costs, the same conditions apply as for acquisitions. In most cases, the cost accounting records for direct and indirect labor costs can be tested as part of the audit of payroll and personnel cycle. Tests of cost accounting records are meant to verify the control affecting inventory that auditors did not verify as part of testing in the preceding cycles. Physical inventory pricing and compilation are each equally important in the audit of inventory because a misstatement in any one activity results in misstated inventory and cost of goods sold. And finally, the relationship between the sales and collection cycle and the inventory and warehousing cycle is not as interwoven. Nonetheless, most of the audit testing and the storage of finished goods, as well as the shipment and recording of sales, takes place when the sales and collection cycle is tested. And so this concludes our discussion of the audit of the inventory and warehousing cycle. I would encourage you to go back and read the chapter and make sure you're familiar with the concepts, the terminologies, and what's presented there. And please don't let this presentation substitute for a thorough read of that text. And then once you've gotten that completed, you can move on to the discussion forum and other learning exercises. And thanks very much.